Okay, recording now and welcome to Cando's Wednesday webinar series. I'm just admitting participants into the session. This is the session with the Chartered Professional Accountants, CPA, and it's titled Tips to Maximize Your Business During and After COVID. I'll just continue to admit people into the session, and then I'll do the formal introduction of our presenter today. My name is Paul Macedo. I'm the Communications Officer with Cando. Okay. We'll just leave a few more minutes to allow for other participants to join us, and then I'll do the formal introduction. As a matter of housekeeping, this session is being recorded and will be made available later today at the Cando website, edo.ca/links-to-learning/webinar Wednesday. And you can refer back to it later on or share it with those that missed it. Okay. All right, so we'll start with the introductions. Again, my name is Paul Macedo with Cando, and I thank you for joining us today. We know your schedule is busy and there's lots of demands on your time, and so we thank you for joining us. So today's session is tips to maximize your business during and after COVID. Our presenter today is Tami Zaranski. She's a chartered professional accountant, and she's volunteering her time today as part of her work with the Chartered Professional Accountants of Canada. Her time here and the session is brought to you by Business Development Bank of Canada, BDC, who was generous enough to partner with Cando to bring the knowledge and experience of someone like Tami to us today. So I've got one more guest to join us, and then we'll turn it over to Tina. Or sorry, Tami. It was Tina that I was admitting.
Perfect.
Okay. Go ahead, Tami.
Okay, great. Well, thank you very much for that welcome. As Paul said, so my name is Tami, and I am a CPA. I actually hold 3 designations that enable me to give these presentations, which is great. And I've been doing them for quite a long time. So the format is we're going to go through the presentation, and there will be a short question and answer period at the end, which you're welcome to ask questions then. It is intended to be interactive. So if I'm talking too quickly or you have a question, feel free to just jump in. I'm happy to answer questions as we go along as well. It'll be about an hour, just so you know. So we have about an hour today. And so Chartered Professional Accountants, just a little background. So the CPA of Canada, so what we do is we work with businesses to keep them honest and successful, basically, is sort of the nutshell of it. It's the largest accounting body in Canada and one of the largest accounting organizations in the world. Now, because of the merger that happened a few years ago with the rest of the bodies. So we only have one designation in Canada now. There are about 210,000 CPAs across Canada. So we're quite large and quite a wide breadth of knowledge. And we work with everything, every industry from not-for-profit to business to for-profit to entrepreneurs, sports, medicine, the entertainment area in the industry. Every kind of business there is has a CPA involved in it in one way or another. So we're responsible for looking after businesses' financials and making sure that that what their goals are, the business goals are, they have the support and the resources they need to be able to grow their business and work towards what they want for their business. So that's a little bit of a background. So we're just going to dive right in. So some common questions. Today's session is really about maximizing business and how we do that in order to succeed in a growth plan within a business. So these are some of the questions that businesses ask. And one of the big questions that always comes up, and one of the hurdles that comes up for businesses, is always around cash. And so your sales are great, but you don't have cash. So what do we do about that? And how do we improve the cash position so that we can use that for expansion, for freeing up other opportunities within the business, and how to make sure that we're paying our expenses and managing our cash efficiently. So these are some of the questions that we consider. So we want to think about what comes to mind when we think of these situations in business about, you know, we're generating revenue and we're buying inventory or we're providing services, but we're going into our line of credit or we're right on the cash line. So we're going to talk about this business, these questions, and some of the formulas and some of the tools that avail everybody to maximize cash within their organization and to know what the goal is. So a typical business cycle for any business is businesses must have available cash for operating activities, purchasing inventory, paying bills, and those sorts of things. Typical business cycle might include this. If it's a retail business, you buy inventory, the customer orders the products, you want to pay your bills, but you may not receive your payment until the end. So as you can see by the slide and the order of events, you spend cash, and then you receive cash. So the challenge is, if you don't receive your cash till the end of the business cycle, then how are you able to buy inventory? How are you able to keep that cycle going? So cash must be used before it's received, and it's important to understand how much cash you need. And this is really the crux of what we're going to talk about today. So how do you plan well in order to make sure that you have enough cash up front to be able to do all the things and provide your clients and customers with the services and the products that they're coming to you for? So the first thing we have to do in order to be successful in this goal is understand what working capital is. So working capital is a measure of the liquid assets available to be used in the operation of the business. Essentially what that means, it's a lot of words to say, you have current assets less your liabilities. So those assets that you hold, which include cash and inventory and accounts receivable, those all fit into your asset category. Your accounts payable will reduce the total of that. And that's basically the net amount of those two things combined make up what your working capital is. And it really is the difference between current assets and current liabilities. And that is the amount of money that you end up spending on things like added services and inventory to be able to provide your clients or your customers with the goods that they require. So let's just take a little closer look at working capital for better understanding. So if we look at on the left side, we have the current assets outlined. So cash, inventory, and accounts receivables. Those items make up what your total current assets are. Now, this doesn't include things like property and equipment or inventory, property and equipment or buildings or capital assets. Those are outside of what working capital is. Then if we look at the difference between what our total current assets are and what we owe, which is our current liabilities, which is accounts payable in this example, we find that our working capital is $90,000. So this is the amount of money that we have available to support the operation of the business. And basically, this is the amount of money that we have to run the business in between the working cycle of the organization. So working capital and sales growth, these two items work together very closely in order to achieve growth within an organization. So while we may only have $90,000, we may need more than that to be able to grow the business, to be able to buy more inventory, to provide more services, to hire more people, to use more resources. And the way that we do that is we look at how do we increase our working capital funds. So this includes existing cash on hand. It includes potential investment of owners or new investors if we want to look at bringing new people in and investing, or we look at lenders. And lending is one of the key components that most businesses continue to use as a very important resource within a business, because it actually increases the bottom line and the value of the business. So in our example, we had $10,000 cash on hand, but let's say that we needed $15,000 additional working capital. If we couldn't sell off our inventory in time to grow that amount of money, then we would look at these additional opportunities and additional sources of funds, including new investors and lenders, or additional investment by owners. And the borrowing of money from your financial institution is, of course, one of the most common forms of having available cash. And this can be through loans or facilities or even lines of credit. So in order to do this, in order to find out, to maximize what our opportunities are within a business, to focus on the growth of the business, we have to understand our efficiency within the organization. And the way that we do that is we look at different key ratios. So when we're working in, and I'm just going to make a note here, the inventory, the word inventory can be also converted into services. So an inventory business would be something like a retail business, but this also applies to services. So if we're providing services to our client, then we would look at days of those services provided. If we do work on a project, or we sell man hours, or we provide investment advice, or like CPAs, we provide accounting services, that would still fit into that first key ratio of days of service. It doesn't have to be inventory. That's just the way that they present it in this. So we're going to look at operational efficiency and how that can be measured quickly in order to convert our sales into cash, because that's what the goal is. It's making sure that we have enough cash to do the things that we need to do within the business, and understanding what that is. If we don't have operational efficiency, this leads to increased debt and ultimately could lead to the end of the business or bankruptcy. So we want to avoid that at all costs. When we examine efficiency, we're going to look at the first ratio that we're going to look at is actually days in inventory. And again, like I mentioned, this can also be days of service, days of work provided. So how long your inventory stays in the company, this is what we're really measuring. If we just speak about inventory for now, I'll just use this example on the board. If we say that we go out and we purchase inventory and it sits on our balance sheet. So the inventory is the items that we buy or the services that we provide. If that is $20,000 and it cost us $18,000 to generate that value of inventory, we're going to want to know what it is in number of days. How many days does that cost us sitting on our books? So this ratio is basically, you take ending inventory, which is found on your balance sheet, or in a service business, it would be unbilled hours or potential work in process. So you take that number and you divide it by the cost of goods sold per day. And you get cost of goods sold per day quite simply by taking the value of cost of goods sold, which is on the amount of money that it costs you to generate your revenue, and it's on your P&L or your profit and loss statement. And you divide that by the monthly number of days. And we always use, for simplicity, we always use an average number of days. So here it's 30. So we have $20,000 worth of inventory or service hours, And it has cost us, and by cost, in this example, it's the purchase of inventory, but in a service example, it would be number of hours or staff hours left to be billed. So 20,000 divided by the average of 18 over the number of days per month, and that will give us 33 days. So that number of days is how many days our inventory takes to actually turn over within a business, which is very important. So that's the first ratio that we're gonna look at. So the next one is actually about the collection period. So again, we have a ratio, and this ratio is regarding how quickly the payment is received from our customers. So we know that we spend money, we buy inventory, that sits on our books 33 days. And how quickly do we receive the payment from the customer? Well, in this example, if we were to look at our ending inventory, our accounts receivable, and we divide that by the number of average revenue per day, we would come out with 45 days. So if we think in terms of the revenue of the inventory sitting on our books for 33 days, but it takes 45 days for us to collect the money from our customers, we have a little bit of a problem because we're not collecting cash fast enough to pay for the inventory that we're basically spending. So just a note, accounts receivable can be found on the balance sheet, and then revenue, of course, is found on the profit and loss statement. So that's the second ratio that we're going to need to know. The next ratio is we're looking at the payment period. So this is how quickly we spend our money in order to either purchase inventory to sell or to pay our employees for the service work that they do. So when we look at this, where our turnover for payments is actually comes out to 25 days. So again, we look at accounts payable, ending accounts payable, and we look at the cost of goods sold per day. So we want to know, again, the cost of goods sold per day is simply just an average. If you're using this on an annual basis, of course, you would change the 30 days to 360, but we're doing it on a monthly period in these examples. So in order to convert, we want to convert our payment, the amount that we're paying out, to a daily rate. We find in this example that it's actually 25 days it takes us for us to pay our bills, our suppliers, and our vendors. So again, when we remember back to the first example, which we'll sum up in the next one, it's actually 33 days in inventory. We don't collect our money for 45 days, but we pay our own money out in 25. So this is called the cash cycle. When we take all of these, and I know it's a lot of information and it's a lot of formulas, so you can take a look at that after, but when we look at the cash cycle, this is basically what happens to our cash within a business. So the cash conversion cycle essentially measures the length of time our cash is tied up within the company. And in our example, we've purchased inventory, we're waiting for payment, and we've paid our vendors. Quite simply, that's what it is. It's the cash collection cycle or the cash conversion cycle that we're speaking about. So when we calculate this, we find that our cash cycle, we cycle through cash once every 53 days. And that means we spend our money in 33 days, we collect in 45, and we pay out in 25. So it's the net of those days is what we actually do with our money. So if we think in terms of a monthly cycle, 53 days almost gets us to 2 months. So it's not too bad. We don't turn over our cash monthly. We turn it over once every 53 days. So that can be obviously improved when we look at things like discounting for prompt receipts and taking cost of discounts versus getting money more quickly. So that's what our goal is. We want to make sure that we're always recycling our money so that the cash comes into us more quickly so that we can do other things with it. When we're waiting for clients to pay us and it takes them 45 days to pay us, if we have 33 days that we need to spend our money in, that sits there without generating income, we're going to have to look at how we're going to close that gap. And that's where those other funds would come in. That's where the other funding opportunities with lenders or other investments would come in to cover that. So let's just take a look at inventory turnover. So again, if you're in a service business, this is also service turnover or man hours worked, or if you're doing a project and paying for your time, like CPAs. We do services, so it'd be service turnover. So inventory turnover measures how many times per year a company sells or turns over its inventory. And of course, it's important for us, depending on what business we're in, to match the efficiency of the turnover period to the type of business that we have. They're not all, and businesses are not all the same. We can look at some businesses that turn over inventory quite quickly, such as a food retailer. Those businesses have to turn over inventory quite quickly to avoid loss and waste. And second, if we look at things like a car dealership, maybe those businesses have a longer period of time where they don't turn inventory over as quickly, but their margins are greater. So it depends on the business that you're doing. There are lots of examples in the industry that you can measure. You can compare your own business to those in the industry to see what an appropriate turnover rate is. We don't go into that in the class. I'm happy to address that subsequently if there are questions about that after the session is over. Just because CPA doesn't provide resources for those, but I'm happy to help you if that's of interest to you. So the inventory turnover rate, we want to make sure that it's in line with market and we're turning over our inventory in an efficient way. In order to do that, we need to know what our inventory turnover is. So again, we look at cost of goods sold, which is the amount of money that we spend to generate the revenue that we're providing. And in this example, again, it's inventory, or if, as I mentioned, in a service industry, it would be service hours. So the average that we look at cost of goods sold divided by the inventory rate, gives us 0.9 times. And this, depending on which measure you're using, this is actually monthly based on the numbers that we're using. So if it were annually, they would be big numbers, but the times would come over. So we want to make sure that when we're looking at that inventory turnover, that it's matching what's in industry. So we know that we're actually being efficient in what we're doing and the work that we're providing. So how do we improve this? There are a couple of things that we can do. We evaluate customer demands and sales to make sure that we're matching what the customer wants and we're meeting those targets. So we align the inventory with projected sales. We eliminate slow stock items and we reduce our safety stock. And safety stock is basically just the buffer that we have in case, such as the toilet paper craze frenzy that happened. The grocery stores have a safety stock in that if something changes that's outside of the norm, that they have additional stock ready to be sold to their clients. Of course, the toilet paper thing went a little crazy and overboard, so nobody had enough safety stock to foresee that, but it is one of the important things that businesses do. So we want to align what we know our customers are going to want, and in service, that can be a little bit tricky. And it comes over time with established businesses. But when we start a new project or we start a new service, there's a little bit of uncertainty. So we want to make sure that we're doing some research and checking the industries to make sure that we're providing the goods and services that are in demand for our customers in the right time frame. We also want to optimize order cycles and quantities, which means we want to have more deliveries more frequently. So we're not sitting on a lot of inventory. We're not tying up our cash by having warehouses full of inventory. And this is something that's changed over the last 20 years. It's changed quite a lot, where it used to be that businesses would stockpile quantities, and especially when we look at businesses such as an IT company, they don't want to have stockpiles sitting there because the IT world changes so quickly that they end up with obsolete inventory, which just ends up costing them more because they can't get their money out of that. So we also want to look at things today in the virtual world and online shopping as utilizing direct ship. So this is something that we can do in a business where we do those quite quickly and turn over quite fast and direct to our clients and our customers. And those things happen. So if there's slow selling items or long-term projects that we're doing, we want to make sure that those are a 1-to-1 ratio, that we're matching what the client needs and we're still providing those services. But we're doing those directly. So those are one-off situations as opposed to our regular turnover, our regular service providers that we're using. And of course, we want to eliminate obsolete inventory. There's nothing worse than having a warehouse full of goods and services that nobody wants anymore, because that, of course, just costs us money and then we can't offload it. So we want to eliminate that. So how do we, when we look at improving efficiency, some of the methods, we want to think about what are some of our own methods at improving efficiency and speeding those up for customers. One of the best strategies to reduce collection period is make sure that your invoices are sent promptly. And this is something that's often overlooked in business. A lot of businesses, mine included, we do invoicing on a monthly basis. And in a lot of situations that works and it's quite appropriate. But the more often you submit your invoices to your clients, the more opportunity you have for businesses to pay you in advance, for businesses to pay you more quickly. So depending on the number of invoices you send out or the bills or the work in progress contracts, you may want to look at doing it multiple times a month. If you were to send invoices out as they're made, as your sales are done, as the project's completed, as the time has passed, and you can complete that in a regular process for your business. If you were to do it multiple times a month, then you wouldn't be waiting. You would also stretch out your payment collection so that people would pay you at different times of the month. Generally speaking, there's always the 30-day terms, but businesses, when they enter invoices, just like we do it on the date of the date of the invoice. So if the date of the invoice is the 2nd, chances are you're going to get paid by March 2nd. If you wait to the end of February, then you wouldn't get paid to the end of March. So sending out those invoices multiple times during the month is a really good way of generating more cash at odd times of the month, which is always important. Enforcing payment terms is another really key point that you want to make sure that you're doing, including due dates and payment deadlines, and taking advantage of those eligible for discount, especially when you're looking at your own payables. You want to make sure that you're taking advantage of the payment discounts that come if you pay in advance or an early payment period. And you offer a discount to encourage quicker payment and to your clients, which may be desirable. That's one of the ways that addresses the question of how do we get our clients to pay more frequently, and how do we get our clients, our troublesome clients that don't want to pay or that have long payment terms, how do we get those people to pay? So that's a really key tip to think of. You want to monitor and react to delinquent payments promptly as well. You don't want to wait till the end of the month, the following month. If you do your collection calls monthly and you find that it's going on and on, it's 60, 90 days, you don't want to continue to wait for another month. You want to make sure that you're calling weekly, you're trying to work with the client to set up collection terms that work for them. And maybe that means setting up a payment plan, or like I said, discounting what your AR is. So that's also important. And when it comes to disputes over AR, which happens if there's some disputes, you want to make sure that you're resolving those on a quick, rather quickly. in order to avoid taking a longer time to settle a dispute, because that will just cost you more in the long run. It also reduces the chance of being paid in the long run. The longer it takes to get those payments from clients and customers, especially when there's a dispute involved, the less likely it is that you're going to get 100% of the money that's owed to you. And of course, today we can utilize things like electronic payments and billing techniques, and electronic billing. This saves mailing time and mailing costs, and also reduces check processing and the cost of checks. This is becoming more frequent. I know it's still a challenge for a lot of businesses to do direct payment or EFTs. There are some challenges with financial institutions still when they look at trying to do this and you facilitate this for businesses. So you want to make sure that you're looking at those and seeing what you can do and setting up direct payment methods, because that will shorten the amount of time that you're waiting for your cash, which is of course the goal. When we think of improving efficiency for payment periods, we want to look at what that means for us. If we're looking at a business, looking at how to pay our bills and when to pay our bills, we want to make sure that we're paying them when they're due and not in advance. I've worked with a number of businesses over the years that have fantastic payment terms and credit scores. And I found that when I went into them, as soon as they got an invoice, they would run them weekly and they would pay out all their invoices out. But then they struggled because they didn't have any cash to actually put growth into the business. And this is one of the things it's an easy thing to implement for businesses. You want to look at the terms of what your vendors are giving you and actually take advantage of those. Maximize any discounts you can when available, but really if you get an invoice and it's not due for 45 days or 30 days, don't pay it in 7. Make a plan to set out what your payment periods are going to be. Maybe you do it twice a month, maybe you do it once a month. It also generates more time within your organization for staff resources to focus on other things, to put into process those things that they can manage on their own with a little bit of help, and then structure those times around key important dates is also important. You also want to look at negotiation with your vendors and suppliers. This is also a key point that's often missed within businesses. You do have the opportunity to do that, and you can do it at any time with your vendors. And most of them are pretty open to negotiating terms. Of course, some of them aren't. It's hard to go to TELUS and say, I don't want to pay you on a monthly basis. I only want to pay you once every 6 months. They may not go for that. But if you're dealing with direct local businesses or especially businesses you have a good working relationship with, you can absolutely negotiate terms with vendors and suppliers. And this is an attempt for you to align the payments that you're having to make with your own cash cycle, your own collection terms that we've already calculated in order to the 53 days. If you know that you're not getting cash for 53 days, or that's what your turnover cycle is, then maybe there's a way for you to extend your own payment terms so that you can align those so that you're not having to go into your line of credit or look at borrowing in the interim. If delaying payments to suppliers, you have to consider for sure the relationship that you have, especially if it's key to your business. You don't want to end up in a situation where you've enforced payment terms and they've turned around and decided that you're no longer one of their key customers. You don't want to risk that. That's not worth it. But you do want to look at, you also want to look at reducing interest charges or hidden costs if you're going to renegotiate terms. So all really important things to think about, but they're all opportunities for you to realign your business, especially during this time where people are struggling and businesses are struggling. They're much more open to making things work and looking at how it works for them and how you can align things together as we go through these very difficult, challenging times for businesses with COVID. So when we look at improving efficiency, we're going to go over an example. So if we're looking at a 10% reduction in inventory, and our days in inventory drops to 30 days from our previous 33, then what does that mean? So here we have this example. This contains some operational changes to improve our operational efficiency and increase our cash collection process. So the net of this example is actually we go from the 53 days to 38 days that we're looking at now. So what did we do to do this? We did a 10% reduction in inventory. We improved the collection process by only 4 days. And an invoice, we invoiced promptly, which saved us 5 days. Improved payment processes, we paid our bills only 3 days later. And the net result of that is we ended up with an improvement from 53 to 38 days. So it's quite substantive when we look at how we can do little changes in our business. We save things like implementing an electronic payment that saved us 4 days of processing collections coming into us, and we increase invoicing more quickly. We actually end up with a substantive increase to our cash collection cycle by quite a lot. So what does that mean in terms of financial results? Well, we looked at our cash stayed the same, our inventory stayed the same, but our accounts receivable dropped. So instead, when we first looked at this example, it was $105,000 in total current assets. Now we're looking at it and it's only $88,000, which looks like maybe a decrease in our assets, but it's because we've actually reduced our accounts receivable by receiving more cash in advance. We reduce our accounts payable because we've taken advantage of a longer payment term, and over time that's flatlined. So when we look at our working capital, we actually improve efficiency by $18,000 because we're not having to spend out $90,000 in working capital. We only now have to spend out $71,000. That's what's required for our current cash cycle and our current operation cycle. So doing small little things to improve our efficiency, because the payment period had been extended by 3 days, and it reduced our current liabilities quite a bit. So that reduction is quite important, even though it's only reflected in a couple of changes that we've done. We now have freed up basically almost $19,000 that we can put towards growth of the organization. And one of the other recommendations that people look at is actually using credit cards as to pay, to maximize those payment terms in order to take advantage of the 30 days or 28 days on your credit card. It can be risky to do that. So if you're going to do that, you have to make sure that you're looking at the turnover of time and making sure that you're paying really close attention to those payment dates, to the deadlines for payment, because the interest rates are so high on credit cards. One of the things that I will mention is if you use credit cards for business, and even if you use them personally, I always like to get this into a lecture because a lot of people don't know this. You can actually call your credit card company and ask them to reduce the rate that you're being charged. And if you've had good credit terms, they will do it. And I've seen credit cards been reduced from 28% down to lower than 12%. So it can be a really substantive jump depending on the company that you use and how long you've held your credit card. So that's also a way to improve efficiency and improve your payment terms. You take advantage of the payment term for the vendor that gives you 30 days. And then if you pay on credit card, you get an additional 30 days. But like I said, you want to be really cautious about the payment terms if you're going to use credit cards for paying, because you don't want to end up paying 28% more than you have to on a business expense. So that'll just cost you more in the end and will ruin your efficiency. So when we look at improving efficiency, ratios, we want to make sure that they should be calculated and monitored. Ratios are not static. They change over time. you want to make sure that you're looking at them and comparing them to industries and watching trends to make sure that if changes happen in your business, that those are accurately reflected and appropriately recorded. If there's growth in your organization, or you change your product line, or you add new services, or you change your rates of service, you would then want to go back and recalculate the ratios that you've been using so that you're using accurate information. If you find that you're going along and you're using these ratios and you have a good solid idea of what your cash conversion cycle is or what your inventory turnover rate is, if you then turn around and find that there's a spike, you want to look at why that happens. So you want to always make sure that you're investigating adverse changes. You want to compare them to the industry as well, and to make sure that those are not one-offs. You don't have to worry so much about small fluctuations within trends, depending on, as long as they're explainable and answerable. It is a general measure for you. It's a guideline to follow to make sure that your cash conversion cycle is reporting correctly and is accurate for your business, and it lines up to what your business goals are in order to preserve cash so that you can use it for growth in the organization. When we look at improved operational efficiency, it can free up working capital. And this gives you the opportunity. What you'll also find is the opportunity of carrying less inventory, of planning out your service hours, or the billing charges that happen more accurately. You can look at maybe making some changes in how your services are provided, or the inventory, the time to provide inventory, and do things like staggering projects or staggering sales to the clients and delivery terms, and getting paid sooner. That also helps to free up working capital, which of course is what the goal is. You don't want to tie up your working capital because this is, again, where debt can come in. So that's sort of an overview. I think that pretty much covers it. There was a glossary of terms that was sent out that talked about all of the different terms that you'll need to know with regards to this slide or this presentation, and how those terms can help you, and how what the purpose of working capital is, and the turnover rates that we talked about, including inventory turnover and collection period and payment cycles. So I think that you all have that. You all have that glossary of terms. You're welcome to let me know if you need any more information on those, or if you want to talk about those as well. You're welcome to email me separately. But that concludes the presentation for today. So we have a few minutes left. If there are any questions, maybe I'll ask Paul to come back on and he can field those if there are any questions.
Thank you so much. If anyone has any questions, now's your chance. As Tami mentioned, there were a number of documents that were provided. We uploaded those to the Webinar Wednesday site in conjunction with Tami's presentation. So all of those materials are there, including her presentation. And in about an hour or so, we'll add the recording of this session as well. So if you've missed anything that Tami had to say, or you need to review it, those materials will be on the website. And I just included the link in the chat function. So you've got that, just copy paste it, or go to the Cando website, look along the top, you'll see the links to learning tab, and then go down to Webinar Wednesday, and then Tami's presentation is right at the top of that page. So if there are any questions, I'd be happy to unmute you and allow you to speak. Or, oh, we have Cindy has a question. Cindy, go ahead.
Okay.
Yeah, the presentation was good. I followed a little bit of it. I've never really done anything for business, but hoping to do some type of home-based business in near future here. And I was just wondering, it's probably in there amongst all them numbers and stuff. I'm not very good at finance management, but hoping to actually get something done there. And I heard about the do not pay early and to pay on the due date, but then I heard as well that when you're paying, don't pay until 3 days later. So does that mean 3 days after the business days? And if you do that, will it have to be right on that 3 days because of, is that considered the grace period time? And before they throw any interest on there.
Right. Yeah, so you want to make sure, Cindy, you want to make sure that you're paying by their due date. I don't know, I don't know what the 3 days grace period would be. I think that when you set up your terms, if you're doing a home-based business, when you set up your terms, it's critical that your vendors that you're dealing with, that you set those terms in advance. If you need more time than the 30 days, then absolutely ask for that. If you find that, you know, you go and you set up, and some places won't be able to accommodate that, but some will. So if you find that there's an opportunity for you to extend your payment terms, then for sure do. But it's really important that you make sure that you pay by whatever their due date is, so that you avoid that interest. In a lot of situations, the interest is charged automatically. So that's also something to consider. It's usually system generated. There are lots of people lots of places that will waive the interest. So you can also ask for that, especially during this time. So just make sure that you keep a close eye on your due date of whatever the payment terms are, and then make sure that you pay that by the due date. And absolutely don't pay it in advance. It doesn't benefit you at all. It doesn't, you know, if you're building credit on a credit card, that's a little bit different. That's about the only, or at a bank with a bank loan or a mortgage, because it's tracked. But you're given the payment terms that you're given. So you want to take advantage of those to your benefit. So for sure, make sure that you're extending that as long as you can to keep hold of your cash. Does that help?
Yes, and I just wanted to know, you know, for the turnover to actually make a profit. I heard you with the discounting some maybe older inventory or stuff like that, and all those numbers changing from you know 33 to some other days or whatever, but
Yeah.
it I just want to kind of know how, are you looking at these figures and ratios and formulas on like a daily basis or weekly or monthly, or what would that look like?
Well, when you're starting a business, you want to keep an eye on it. It's a little bit tricky to do when you're starting just because you don't have history. So what I would do is when you're starting your business, you want to set that out, you know, as soon as you have some kind of trend. So as soon as you build clients or your customers, and as soon as you start receiving money, then you can take a look at how your turnover is working. You can't really do the ratios until you have that information to plug in. But then I would look at it on a monthly basis going forward for the first 6 months to a year. I would make sure that I was calculating that repeatedly just to make sure that there's actually a trend, to see what's happening within that period. And then as your trend stabilizes, you can look at it, you can recalculate it less frequently, especially when you're starting in the beginning. You want to make sure that you're tracking what your inventory is, or your business, your turnover, and identifying where the revenue and where you're making the profit is coming from, on both the inventory side, but also with your payment side. So when you're going forward and you're calculating these trends, you want to also be sure that you're calculating your payment period component too, which is you wait for 30 days to pay, or whatever the terms are, your payments for your invoices for your vendors are, and calculate that also into the formula. So for sure, it's important to do it in the beginning quite frequently. I don't think that you need to do it weekly. I would say if you did it on a monthly basis, then it aligns with your payment period and your invoicing period and your revenue period as well. So.
Okay,
Oh.
I was just wondering about taxes for home-based businesses. Is that an option? Do I have to do that, or can it just be on the cuff?
It depends on what your home-based business is. We didn't really go into tax in this presentation. But there is another presentation that discusses tax, so we could look at doing that one if Paul was interested in doing a tax presentation. I think that what I will tell you, just to give you some information, is that whether you register for GST is going to depend on your specific situation and what the amount of revenue is that you're generating. You're not required to register for GST until you generate $30,000 of revenue. So my suggestion is not to volunteer to do that, because you don't need the added paperwork and the added time. You can simply wait until you get to that limit. But it will depend on the type of business that you're doing and what it is, the service that you're providing. So you want to look at those things. And like I said, there is another presentation on tax that you might be interested in, but I'll leave that up to Paul to decide.
Yeah, Cindy, the other matter is where you're located. If you're on reserve, there's different implications for tax. So you should check check with EDO in your community, check with people that are already in business. If you're starting a home-based business, just do a bit of research and see what the tax implications would be for where your home-based business will be located. Tami alluded to it. We have 4 more sessions scheduled for next week with volunteers from the Chartered Professional Accountants. So we have 2 sessions on Tuesday next week and 2 more on Thursday. Each one of them will be different. And the descriptions for those sessions are on the Cando website, edo.ca. Go to the links to learning tab and then look for the dates for next week. And you can just plan which ones you want to attend based on what your needs are. But in all cases, all the sessions will be recorded. All the materials presented will be retained. And so you'll be able to reference all those materials just like you will Tami's today after this session is over. So if there are no more questions, we're going to wrap this up. Thank you, Tami, so much for sharing your expertise.
It was my pleasure. There is the only last thing I'll say, and I know that this was sent out, there is an evaluation form that we'd love to get back if everybody could fill that out. And Paul, if you could just send those off to me, that would be fabulous, just so that we get some feedback from everybody about how you enjoyed the presentation or if you have suggestions. If there are other areas that you're interested in, for sure include those, and we'll see what we can do. But I appreciate your time, and thanks very much for inviting me to speak to you all today.
Thanks
you.
again, Tami. Thank you all for joining us today. We know that time is precious, and we thank you for taking some of your time and choosing to spend it with us. So have a wonderful day, and the recording will be up in about 1 hour. Take care.
Great.
Bye.
Thanks, everyone. Have a great
Yeah.
day.
You too.
I know.